What's up everybody, welcome to VC. My name is Vincent.
And I'm Chloe. In our previous video, we mentioned about refinancing a property where you get to cash out the money from your property to buy another property. So for our topic today, we will be sharing some things you need to know about refinancing. We won't be going into super deep into it, but hopefully it will be enough for you to get the rough idea of refinancing.
The definition of refinancing basically means that you are replacing an existing loan with a different loan, and this new loan carries different terms and pay off the remaining debt of the original loan. Do take note that refinancing is for you to replace for your existing loan with another bank.
For example, if you're really loyal to one bank, then you want to replace the loan and take another loan from the same bank again. This is called restructuring.
Yep, it's important to understand the difference between restructuring and refinancing, because restructuring a loan may seem to mean that you are financially unstable and unable to meet the debt obligation. Restructuring can also affect your credit score, which is why it is usually a last-ditch strategy.
This is because the lenders, which are the banks, don't want the borrowers to default on their loans because of the financial situation borrowers are going through. It's like you're ditching this loan and taking up another loan to repay back the other loan and to get the extra cash from the exact same bank. But do check with your mortgage banker, since this depends on banks too.
Yep, but on the other hand, refinancing is used more liberally than restructuring because it is a quicker process, easier to qualify for than restructuring. And not to forget, it gives you a positive impact on your credit score, since the payment history will reflect on the original loan being paid off.
Firstly, let's talk about how refinancing works. Let's say you have a property you bought 10 years ago priced at 300,000. The current value of that property right now is 500,000. This is just for ease of calculations. So in these 10 years, you've basically paid for your loan maybe 100,000, and now you're left with 200,000 which you owe Bank A. Now, you can head to Bank B and let them know that you would like to refinance this property. So the bank will let you refinance 80% of the value of the property. We mentioned just now that the value of this property is 500,000, which means it's gonna be entitled for 400,000. Now Bank B will lend you 400,000, so you can settle the loan amount of 200,000 that you owe Bank A. Then you will be receiving the balance amount, which is 200,000, and this is the amount that you can cash out.
Yep, the question is, why do homeowners or investors refinance their properties? There are actually a lot of reasons why owners refinance their properties. Firstly is to tap into the property's latest market value in order to finance a new purchase. Refinancing helps you to get a huge sum of money, which most owners, especially investors, use to buy a new property. This is usually when they're looking into buying a subsale property, which requires 10% of the down payment, even an under construction property known as project development.
So with the money you can cash out after refinancing, this gives more opportunity for one to continue buying another property. Interesting, right?
Yep. Another thing that we find more interesting is that experienced investors, for example, have a property A. Property A is rented out for 2,500 ringgit per month, and the monthly installment of the property A is only 1,500. Probably because they bought it 10 years ago back then. So this investor will head to a mortgage banker and let them know that he or she wants to refinance the property and proceed to tabulate the installment based on the current rental rate, which is 2,500. We can take out the sum of cash out, but the property will still stay at a break-even stage between the installment and the rental rate. This is one way investors do where they don't have to cough out extra money every single month. And we actually find this super interesting because even if you're technically taking up a new loan, yet the installment is still covered by the rental income.
Now, the second reason why people refinance their property is to obtain a lower interest rate. This is pretty straightforward but easy to understand, as banks are in a business too, right? So when you head to another bank to refinance your property, they will come up with a proposal on what they can offer you to refinance. So they can either play with the interest rate or the loan tenures. Sometimes a competitor bank may offer you 1 or 2% reduction in the interest rates, which means you'll be saved from paying so much interest rate, which is also means that you might be paying a lower monthly installment. If you're renting out that property, you may be able to improve your rental cash flow position from a potentially negative to positive cash flow since the installment is right now low.
Yep. And for those who actually sign for a fixed loan, this is actually a good opportunity to refinance the property since the interest rates now are just so attractive.
Yeah, but when it comes to playing with loan tenure, some banks may even offer you a shorter loan tenure provided the installment amount stays the same. This means you pay the same amount you have always been paying, but you're able to pay off your mortgage loan in a shorter period of time. This would allow you to have savings on total interest that you need to pay the bank. But because usually for people who own a house more than 7 to 8 years, the interest that you're paying right now is getting lesser and lesser.
Yep. Either with the difference of loan tenure or interest rate, every single person have their own KPI, the key performance indicator. So it depends on the bank on what they can offer to you to make you refinance that property.
Another reason why investors or homeowners refinance their property is debt consolidation. If you didn't know, a mortgage loan is the cheapest financing option compared to overdrafts, a hire purchase, credit cards, and personal loans. This is when you can put different loans into one, where you can add in your credit card debt, your housing loan, your car loan, so they would tabulate the amount, and it's quite convenient because you just have to pay this total sum every single month, and it's at a better rate as well.
Yep. On the other hand, some investors or homeowners who have big debts like a massive personal loan or a credit card debt would refinance the property and cash out the balance to pay off the massive debt. For example, the investor has a 200,000 credit card debt. The property that this investor owns was bought at 300,000 few years back then, owning the bank only 100,000 now. The value of this property is 550,000. After refinancing, he or she has 340,000 after paying the previous housing loan. With this 340,000, this investor can pay their credit card debt 200,000 instead of owing the bank credit card debt, which is generally 16 to 18% per year. That's quite a lot. While a housing loan interest rate nowadays is only average around like 3%.
But if you're planning to refinance your property just to pay up PTPTN loan, then we wouldn't suggest so, because your PTPTN loan is just 1% interest, so there's technically no point. Changing a mortgage loan is also one of the reasons why people refinance their properties. Some clients who previously signed up for a fixed loan can refinance and change it into a semi-flexi loan.
As good as refinancing sounds, many actually forget that refinancing also means you are taking up a new loan. In this case, you have to pay for the moving cost.
Moving cost refers to money you have to spend on taking up a new loan. Items such as valuation fees, your legal fees, your stamping fees, disbursement fees are payable when you refinance.
Yep, if you own a property for 3 years and the capital growth of that property did not raise that much, for example, it is only raised from 500,000 to 550,000 and you still owe the bank around like 420,000. After 80% of refinancing, which is 440,000, then paying previous bank you owned around 420,000, you are now left with 20,000. And you have to pay for the moving fees, right? So would it be worth it to refinance a property to live with maybe a couple thousand after paying off all of the moving fees?
Don't forget, you also have to check with your existing loan if it has a lock-in period and is still bounded by it. Banks normally charge a penalty of 2 to 5% of your original loan amount if you fully pay off your mortgage within the first 2 to 5 years. Yeah. In this period, you will be caught up with a penalty for settling the loan earlier because of the lock-in period of your mortgage loan.
Yep, what is the process of refinancing, you may ask? It is basically the same as taking up a new loan. They value your property, provide you a proposal on the refinancing, then just the same as taking up a loan.
But of course, before refinancing, we do suggest you to check up with a few banks to find out the deal that they are offering. So only submit to a bank where they meet your objectives, since different banks provide different offers to their clients. In some cases, your moving costs may be also fully absorbed or partially absorbed by the bank, while in some cases, these move-in costs can be added into your loan amount, which means you don't have to pay for the amount upfront, but you're still paying it long.
Yeah, basically. You can also try to negotiate for better ELR, effective lending rates, if you're not in a rush to cash out the money. In our opinion, refinancing does actually provide many benefits, but of course you have to use it right. Don't use it for leisure, but despite how good it is, always remember to check with the mortgage bankers on what is the catch, or maybe how they calculate the eligibility of refinancing.
This all depends on the banks, but we've heard before that the debt service ratio, DSR, where they calculate your eligibility to be eligible for the refinancing, is a bit different than usual. For example, the property now value is worth 500,000. After 80%, it is 440,000, right? So you owe your previous bank 250,000, so 250,000 would still be calculated according to 35 years, but the remaining of 190,000 will be calculated according to 10 years. This doesn't affect the new mortgage loan that you will be getting, but it affects the eligibility of you to refinance this property. This is done to ensure that you have a strong repayment capacity.
Yeah, 100%. Yep, so that's all from us today. Hopefully from this video, you will now understand refinancing better, and probably sooner or later, or maybe a few years down the lane, you might be planning to refinance your property for your own personal reasons, whether it is to fix a mistake you made back then, 15 years loan, 10 years now you want to get a 30 years loan, or maybe you want to cash out to buy another property. Right? Yep, so that's all from us today. Thank you for watching. If you get some new knowledge from this video, do give us a like and consider subscribing, as we post a lot of property real estate related content in this channel. Join the VC family, and we will see you in the next video. Ciao.